Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to go over the best stocks going ex-dividend next week, December 24th through the 28th, 2018. We're going to be going over 5 of the winners this week. Number 1 was Bank First Corp, ticker symbol BANF. This one has 16 years of dividend growth. We have the Portland General Electric, ticker symbol POR. This one has 12 years of dividend growth. We have Altria Group, ticker symbol MO, 9 years of dividend growth. Regal Beloit Corp, ticker symbol RBC, 8 years of dividend growth. And Thor Industries, ticker symbol THO, with 8 years of dividend growth. So those are the 5 stocks we're going to be going over in today's article. These are already posted over on my website, so if you guys would like to read the article, there's a link in the description below to my website, but I also have this in the comment section. I'll have a link specifically to this article. And if you guys would like to subscribe to my blog, that way you'll get notified every time I do put up new posts. Enter your email address and subscribe. And of course, we've already gone over the ticker symbols. So as I post the video out, it'll be uploaded onto here and just available. Now, I screened 100 stocks this week, and I removed any stocks that had starting yields less than 1.5%. So all of these have a 1.5% starting yield or higher. All of these have had rising revenue, net income, free cash flow positive over the last 5 and 10 years. And their next year earnings per share is expected to grow over their current earnings per share, and they've all grown their dividend for the past 5 years or more. Now, I did have a few other runner-ups here that all made it through the same screening process. They just did not have, I just sorted them by how long they've been growing and paying out a dividend, and then we only had one financial this week that kind of met our criteria, so I went ahead and kept it. Now, in these videos, we go over the ex-dividend date, the dividend date when you would get paid, price comparison to the yield, PE comparison to the industry and the S&P 500, the payout ratio, dividend history, and a few other items. Now, I do have a couple recommended books here. The Snowball Effect goes over, creating your portfolio of dividend stocks that all raise, if you're buying stocks that raise their dividend every year, plus those dividends are reinvesting back into more shares, which are paying you out more dividends, which are raising their dividends. So it goes over the whole snowball effect of just building up this portfolio that just begins to pay out and reinvest into itself. And if you are starting your investment journey, my 2 recommended brokers are M1 Finance. If you're a long-term investor, don't mind buying, whenever. Or I do have Robinhood on here, but the other one for other investors is First Trade. I haven't used it myself. I just heard really good things about it. I've created 2 free apps that are available on the Google Play Store, Simple Dividend Calculator and the Simple Retirement Calculator. You can click on the links and I'll kind of go over what exactly they provide, but you basically get your retirement number, how much you need to invest weekly, monthly, yearly in order to hit your goal, and then just a compounding calculator there. Now again, all these stocks are ordered by when they go ex-dividend. So first up next week is number 1. Ticker symbol POR. This is the Portland General Electric, and they engage in the generation, purchase, transmission, distribution, and retail sale of electricity in the state of Oregon. That's where I'm from and where I'm at. So this is a utilities company. Its ex-dividend is next Monday. You'd have to buy this one this Friday or prior, hold it until Monday, and then you would receive that payout on the 15th of January. Now, I do like to show their 10-year graph here. Let's see if I can zoom in just a tad there. There we go. One more time. Okay. I don't know why this is so blown up there, but I think that's a pretty good. 250 looks pretty good. Okay, so here I like to display their 10-year graph. So here, over the last 10 years, their price is up 135.5%. In the green, their net income is up 64%. In the red, free cash flow up 61%. And in the orange, their revenue is up 11.16%. So you can take these numbers, divide them by 10 over the past 10 years, and you're going to get your average increase per year. So for example, price, 135 by 10 is 13.5% on average for the price increase. Just a very steady increase there in price. Now this one, it's a utility company, so there's not a whole lot of utility companies within a specific area of the city. Portland, for example, Everyone has to use them, so it's very steady as far as what they're going to be producing as far as their revenue, free cash flow, net income. You can see free cash flow did dip here. That could have been some acquisition that took place, or they just needed some free cash flow in order to pay out dividends. You just have to look back over the yearly reports and kind of find out where exactly that cash flow had went out and take a better look from there. But moving down, we're showing up the 1-year graph now. So this stock here pays out 36 cents and a fifth of a cent there, 2/10 of a cent, I suppose. So it pays for a little over 36 cents per share each quarter. You can see they did increase their rate back in April of 2018 from around 34 cents to now 36 cents. They're currently trading at $47.51. So here, back between February and June timeframe was, they were trading down in that $40, $38 range, and now these were looked at, it's a utility. So right now, healthcare, utilities, and industrials are looking pretty good as far as the safe sectors to kind of move money into. So here, utility has been propping up very nicely out of those lows early in the year, whereas the rest of the S&P 500 is probably negative. Portland General Electric is actually pretty positive right now. Their 200-day moving average is at $43.97, so they are trading above their 200-day moving average. Here, their dividend yield currently is 3.05. So yeah, this is correct. Depending on the day where we have, price rises, the yield's going to go down. If the price goes down on the stock, then the yield's going to go up slightly. So this one currently has a PE ratio of 20.66. In the purple here, their price to sales is 2.1, and their price to book is a 1.7. So when charted, I'm going to have to zoom out there, that way you can kind of see the chart and the information. So when charted above, it does show the current stock does have a price over the yield currently for the year, which could mean it could be overvalued at this time. The stock is traded above the industry average of 19.2. It's currently trading at a 20.66, but the earnings are expected to go in 2019, meaning that it may put them below their industry average. And they are currently also trading above the S&P 500. Right now, the S&P 500 is trading around a PE of 19.54. And I believe it went up flat on... I wrote up this article on Monday. So Tuesday, we had another fall of about 2%. So the S&P may be trading below that 19.54 right now. So S&P is looking pretty far down there in comparison to earlier this year, where it was at a 26 PE ratio. So it has fallen by a nice amount. Now, this one is trading above the 60% payout ratio, but it's a utility company. It's at 62%, which is, right in there with other utility companies. Dividend growth for the past 12 years since 2006. Now, its price to book value, again, 1.7, which is below 3.0, where asset-based companies would be considered a deal. And its price to sales is also below it's below 3.0. It's at 2.14, which is where sales and service-based companies would be considered a deal. This is more of an asset-driven company, so 1.71 would be the book value there that you're kind of looking at. Now again, starting yield right around that 3% starting yield for a good utility company. We have annualized payout. If you multiply 36 cents by 4, you're going to get roughly $1.45 per share each year. Payout ratio is 62. Their dividend growth has been pretty slow over the last 10 years. They came out of, I don't have the dividend here, but they did cut their dividend, I believe, fairly low. I don't know if they completely gutted it, but I know they did cut it prior to 2006. 2006, just when they started raising it again. I believe there was a period between some 1990s and 2006 when they kind of just cut out and stopped paying a dividend or cut it very low. So their dividend growth has been very slow at 4.7% over the last 10 years. And that would be Portland General Electric. Number 2, we have ticker symbol MO. This is the Altria Group. It is a holding company that owns cigarette maker Philip Morris USA. The company also offers cigars through its John Middleton subsidiary and holds a portfolio of leverage and direct finance lease investments through its Philip Morris Capital Corporation. Now this one is in the consumer goods sector, or sin stocks. Its ex-dividend is again on Monday, the 24th of December. You'd have to buy this one this Friday or prior in order to be eligible for that payout on the 10th of January. Altria currently has fallen off their highs. Some back in 2017 was their high point. You can see here as of their August sometime of 2017, this company has gone, it was up maybe 425% over the last 10 years, and it has now pulled back to roughly 256% over the last 10 years, still putting it at an average return of 25.6%. Now here in the green, net income up 11.6%, in the orange, revenue up 6.7%, and in the red, free cash flow at 5.4%. Now, taking a look at their 1 year, they currently pay out 80 cents per share. Here you can see a nice hike from 66 cents to about 68 cents, and then another hike here from that 68 cents to now 80 cents just very recently. They're currently trading below their 200-day moving average at a $52.35, whereas their 200-day moving average is $59.16. Their current dividend yield as of that hike, it was at 5.46, but because they raised their hike from around 68 cents to now 80 cents, that puts their dividend yield starting at around 6.11, which is a very high starting yield for a consumer goods company. Now, this stock is trading below the industry average. It's trading at a 19.33. Its price to book, 6.34. And price to sales, so this is a sales-driven company, is at a 3.9. So when charted, it does show the current price is underneath the yield. You can see the price way down here, whereas the yield is way up on top. The stock is trading below the industry of 13 and below the S&P 500 PE average of 19.54. It is price to book 6.3, above 60% payout ratio. So it does have a fairly high payout ratio of 80%. So, as long as people continue to smoke, this company will do fine over the, in the future. But if there is any sort of indication that the millennials and generations will begin to quit smoking, I know Altria just bought into like a 40% stake in some cannabis company. So they're trying to jump into that as well. So we shall see how that all plays out for them. And they have grown their dividend for the past 9 years since 2009. Now the price to book here is 6.39 for those asset-based companies, and their price to sales is at 3.91, which is above 3.0, where sales and service-based companies would be considered ideal. So it doesn't fall below that 3.0 range very often. You can see here this is one of the lowest points currently of the past year. I don't have the charts here for the history of the company here, but over the long term, this company doesn't trade at a price of sales of 3.9. Dividend yield, again, starting yield around 6.11, annualized payout $3.20 per share. Annualized payout is 80%, and they've grown their dividend for the last 9 years at an average increase of 15% on average per year. Now, they did a huge rate hike here from 68 cents to now 80 cents. So that is why their payout ratio is slightly higher, because they're paying out more of their earnings to their shareholders just due to that rate hike. So they are probably expecting some sort of an increase there in their earnings, I would expect. But I haven't looked into that in a minute here. Number 3, we have ticker symbol THO. This is Thor Industries. They manufacture and sell recreational vehicles and small and mid-sized buses, and as well as related parts and accessories in the United States and Canada. Their sector is consumer goods. They're going ex-dividend on Wednesday, December 26th, 2018. You would have to buy this one on Tuesday or prior, hold it until the ex-dividend date, and then you would receive your dividend payout on the 10th of January. Here, again, over the past 10 years, in the green, net income up 102% on average per year. You can see a bit of a pullback. This could be due to the tax reform. Tax reform has affected many companies, showing that their net income has actually dropped, but they're just able to write off and do stock buybacks and such. In the orange, revenue up 30% on average per year. In the blue, price up 29.7%, even after falling off their highs at the start of 2018. You can see that this one was up, crazy high, maybe some 650, 700% at over the past 10 years, where it has fallen down to 297%. So still fairly good, but it just, it's fallen. I'm not sure how much this one has fallen. I'm sure I could just pull it up on CNN here, and whoops, where am I going? markets. Oh, I guess I could have just clicked on one of these and typed in THO here. And then year to date, here's what I want to do really quick. Year to date, they're down 65.7%. So they're right at that point now, which may be considered a good deal. In the red, we have free cash flow up 18.9% on average. Now, looking at their 1-year chart, they currently pay out 39 cents per share each quarter. They raised their dividend from 37 to 39 cents per share. Their 200-day moving average is $93.19. They're currently priced at $53.69. Their current starting yield is around 2.91%. So that looks about right. Maybe a little bit higher just due to the recent increase there in dividend. Their price to earnings PE ratio is 8.81, price to book 1.4, and price to sales here at 0.35. So when charted, it does show the current stock does have a price under the yield, which may indicate it could be undervalued at this time. The stock is also trading below the industry average of 13.1 and the S&P 500 average of 19.54. It's currently trading at the 8.81. Now they are also trading below 60% payout ratio. They're at an 18.6% payout ratio and have grown their dividend for the past 8 years since 2010 at an average increase there in their dividend of 45%. Their price to book, again, 1.44, which is below 3.0, where asset-based companies would be considered a deal. And their price to sales is at 0.35, which is also below 3.0, where those sales and service-based companies would be considered a deal. This being a automotive, I would say it's more sales-driven. So that's very, this is something. When you see a company that's actually below 1.0 for its price to sales, that's kind of a weird indicator. I know I've had it in I haven't seen that before. I don't think. None of the companies that I've ever really looked at in the past have shown a price to sales really below that 1.0 ratio. So interesting there. So it was Thor Industries. I know there's one other YouTube channel that does own that specific company. I do not. Number 4, we have ticker symbol RBC. This is the Regal Beloit. They manufacture, distribute, and sell electronic and mechanical products within the United States, Canada, Mexico, India, Australia, Thailand, Europe, and the Republic of China. It also operates in multiple segments, electric and mechanical. Their sector is industrial goods. They're going ex-dividend on the 27th of December, which is next Thursday. You'd have to buy them on Wednesday or prior, hold them until Thursday, and you would receive that payout on the 11th of January, 2019. So here in the red, free cash flow up 12.7% on average over the last 10 years. In the blue, price up 10.8%. You can see a very steady sideways trending stock here, up 10.8% on average per year. And the green, net income up 7.98% on average per year. And in the orange, we have their revenue up 5.9%. So very steady numbers there as far as their financials go. Now, taking a look at their 1 year, they currently pay out 28 cents per share. Their 200-day moving average is at $78.54, and they're currently priced at $70.77. They have a starting yield of 1.58, 1.53, just within that range depending on the price of the day. Their current PE is at a 13.8. Their price to book, 1.31, and price to sales, 0.87. So when charted, it does show the current stock does have a price underneath the yield for the year, which may indicate it could be undervalued at this time. The stock is trading below the industry average. It's trading at a 13.8. The industry is 17.2. The S&P is 19.54. It is also trading below 60% payout ratio. It has a payout ratio of roughly 18.9% and has grown their dividend for the past 8 years since 2010. Its price to book, 1.31, price to sales, 0.87, puts it below 3.0 for asset, sales, and service-based companies. So it may be considered a deal, doing a little bit deeper research as to why it's trading with a price to sales below. Yeah, it's another sales-driven company here. So why is this one also trading below that 1 ratio? That means that the price in comparison to their sales side of the company, they're actually priced below it. So interesting there. And they've grown their dividend roughly at an average of 7.5% over the last 10 years. That would be ticker symbol RBC. Number 5, we have ticker symbol BANF. This is the Bank First. They operate in as a holding company for Bank First, which provides a range of retail and commercial banking services in Oklahoma. Their sector is financial. Their ex-dividend is the 28th of December, which is next Friday. Their payout date is the 15th of January. This company here is also kind of doing what many other financials have been doing this year, which are dropping. It's actually done really well up until just recently. You know, JP Morgan, Goldman Sachs, Citibank, what else is out there? Wells Fargo, those have all sort of gone down some 20% for the year. This one, on the other hand, what was the ticker symbol? FI. Oh, it was completely off. BANF. BANF. This one here, year to date, I believe it's slightly higher. So this one's still up year to date, whereas most of your big financial corporations are actually in the negative by some, Goldman Sachs, I believe, was down some 20-30%. So very a little bit different there. So in the green here, net income up 15.3% on average over the last 10 years, or 153% over the last 10 years. So over the last 10 years. In the blue, price up 12.7% on average per year, or 127%. In the orange, 7.7% for their revenue, or 77%. And in the red, free cash flow up 6.1% on average per year, or 61% for the last 10 years. So very strong financials there as well. All over 6% there on average, up to 15% there for their net income. Now, taking a look at their 1 year, they raised their dividend here. They had restrictions let off on the financials, so this one increased their dividend from around 21 cents to 30 cents, so they increased it very nicely as well. They are trading below their 200-day moving average of $58.91. They're currently trading at $51.80. They have a starting yield of 2.32% due to the increase there from 21 cents to now 30 cents. It would have put it basically off there. So 30 cents, that gives them a starting yield of 2.32. PE ratio at a 15.37. Price to sales, 4.5. Price to book, 1.9. So when charted, it does show the current stock does have a price under the yield, which may indicate it could be undervalued at this time. The stock is trading above the industry average of financials at 11.9 and below the S&P 500 PE average of 19.5. It is below the S&P. It does have a 32.7% payout ratio, which puts it below that 60% payout ratio, and has grown their dividend for the past 16 years. So this is the longest paying and growing company here within the list this week. Their price to book, 1.91. Price to sales, 4.55. So price to book is below 3.0, where asset-based companies would be considered ideal. Price to sales, 4.55. Financials, they normally fall, price to book is important for them, where they're asset-based companies. So here at a 1.91. Financials wise, I've seen people, go for anything under 2 is a good metric for price to book on financials. If you look at Goldman Sachs, JP Morgan, they generally trade with a 1.7 price to book, right in between that range there. So starting yield 2.32. They pay out $1.20 per share for the entire year. Payout ratio 32.7. And they've grown their dividend for the past 16 years at an increase of 17.2% over just the last 2 years, since 2002. So that is basically it for this video. If you guys did enjoy the video, check out the article. I will have it in the description below. And of course, if you do like the video, do like the article, share it with your friends that are interested in dividend stock, share it on Twitter and all the other social media platforms. Quick disclaimer, I am a holder of Altria, ticker symbol MO. It's been in my portfolio for the last year. It's a great company as far as what based off my opinion. I think it has strong financials. It's not why it's in the list. It's in the list because it made it through the metrics that I measure and screen all my stocks for, and it had 9 years of growing and paying out a dividend. That's the only reason it kind of made it onto the list. So the other company here, Portland, I'm from Portland, but again, doesn't have anything to do with me. And that is basically it. I don't really, if I had to pick one stock, I'd probably go with Altria just because it has a starting yield of 6%, which is fairly hard to find inside consumer goods. I am still holding Altria and don't expect to kind of sell them off anytime soon. So Great company. I think they're going to be moving forward in a good direction. So, quick disclaimer in addition to my other disclaimer, I am not a financial advisor, tax professional of any sort. The information provided in these videos is my opinion for entertainment and fun. This is just me as another financial investor trying to help others make their money work for them. If you have any questions, let me know in the comment section below. If you are brand new to the channel, of course, hit that thumbs up button below, leave a comment, subscribe, and I will see you next time in the next video. Have a great day. Bye.